While everybody is panicking and losing their shit in the sea of red in the stock market for the month of November, I'm going to keep calm as a cucumber and show you how to take advantage of this volatility and sell a cash secured put on a very reputable stock that absolutely had a home run in earnings called SOFI, SOFI, which is a fast growing non-brick and mortar bank. In today's video, I'm going to show you how I sell cash secured puts, my parameters, my dates, my strikes, and what I look at, and how much percentage I want to make on that play. Because while everybody is going crazy, we stay calm and stacking our paper. Before I do, I want to say, if you're a new investor, I get that you're scared. If you've been here for a while, there's no reason to be scared. Let me put some things in perspective. Most of the things happening right now is based on uncertainty if the Federal Reserve is going to cut rates in December. This certainty was here about a month ago, but then Jerome Powell literally came out and said, there is no certainty that we will be cutting rates in December, although I personally think rates should be cut significantly because except for this AI, CapEx, AI building, this is what's propping up the GDP. Most companies, most people are still suffering. Now, I don't think this is an AI bubble whatsoever, but I am saying that the economy does need stimulus in the form of rate cuts. So with that said, we literally had a massive, massive year. Everything is up. Even now with the SPY being down the last couple of days, we're still up in the teens. We're still up 13 or 14% for the year, which is a normal, good year for the SPY. We're just getting too greedy. 3 positive years with 6 positive months of the stock market. Things pull back. It's okay. And this is all based on this fear that rate cuts might not happen. And you are essentially fighting the Fed if you are investing in growth names, growth companies. Do with that what you will. I'm not your financial advisor. I'm purely just entertaining you and giving you my own journal. None of this is advice. If you don't know who I am, my name is Adam Bergman. I retired last year at the age of 41 years old. I believe in 3 pillars: multi-baggers, high-paying dividend stocks for your bills, and then selling options to generate premium to retire or supplement your 9 to 5. I personally made over $1 million selling options premium, and I have a website. The link is down below with a 15% off for the first month for Thanksgiving. If for whatever reason you don't want or like my website, full money back, just email me within the first 30 days. I'll refund you 100%. We do lives every single Monday for many, many hours, amongst a lot of other things that the website gives you. We are literally a community that's building organically, and it's only $50 a month without the discount. No reason for you to pay these online gurus thousands and thousands of dollars for their bullshit courses. I'm going to show you my screen right now, and I'm going to show you how I walk through a cash secured put. Before I do, let me give you some parameters of what I like to do. These parameters will change in a bull market or a bear market. So maybe in 2026, these will change. But right now, this has served me really well over the last year plus 2 years. What I like to do is I like to go 4 weeks out when I sell my cash secured puts. The golden rule is 4 to 6 weeks. I like 4 weeks. This is the perfect balance between managing and getting the most advantageous position possible for you with theta decay. Theta decay is when time value gets reduced from your contract in your favor. You collect the premium, somebody's paying you for the cash secured put. You are saying you're willing to buy shares at a certain price, and the contract loses value every single day if everything stays the same due to time decay or theta decay in your favor. The last 4 weeks are very, very aggressive, and that's good for you as an option seller. That's why I don't like to go longer than that. And any shorter, it's very hard for me to manage thousands of contracts on a shorter period of time. At the end of the day, you do what's good for you. When I sell my options, I like to pick 80% in my favor. I'll show you a screen in just a moment, and a 0.20 delta or less. And then that must pay me 2% on my money. So if the collateral or the money that I'm putting up pays me 2% with an 80% chance in my favor with a 0.20 delta or less, this is possibly a viable contract for me to get into, for me to sell. And then I stack this with a bunch of other things, for example, TA and many other things. But we're going to keep it stupid simple in this video. I just wanted to give you the basics, the parameters, so on and so forth. When I do this, I like to use margin as my collateral. This is different than naked puts because I can cover the play if I needed to by selling out of my shares or dumping in some cash to cover the play. However, so far, so good. It's been an amazing, amazing year. And by me using my margin as collateral, but not actually get assigned through intelligent rolling, managing, getting out of the position, so on and so forth, I don't have to pay any interest because there was no actual transaction of me taking ownership of the shares, which means I am printing money like the Federal Reserve should be doing, but is not. Take a look at the screen. This was their last earnings. As you can see, this was the estimated. The dark number is what they actually did. And as you can see, SoFi essentially smashes expectations in pretty much all of their earnings. And you can see this is up and to the right. This is a phenomenal, fantastic company that people are getting on a discount right now. I love this company. So for me, this is a great company to sell cash secured puts on, and I'll take advantage of the dip. Even with the dip, it is still up 76% for the year and is delivering on all cylinders. But this is not a video for my bullishness on SoFi. This is just let's take advantage of the dip that's been happening of 14% over the last week. If I wanted to do this, I would press trade options. Instead of buy, I would press sell. Instead of call, I would do put. I am selling a cash secured put and somebody's paying me for this. Somebody is paying me defense. They want insurance to say, hey, if the price drops more, somebody will buy my shares at a certain price. I like to go 4 weeks out. Now, this week is already kind of the middle of the week it's turning into, but let's imagine this was Monday. Let's go 1, 2, 3, 4. So I would go to December 12th. The next thing I would do is go for my chance of profit, and I would go all the way to 80% and start from there. And if the 80% also gives me a 0.20 delta, and this ends up giving me 2%, which I'll calculate in just a moment, that this is a possible viable play for me. If you don't have a percentage in your favor because for whatever reason you don't have Robinhood, just do the opposite of delta. The definition of delta is the amount a contract moves as relation to a $1 movement of price of the shares of the stock that you're picking. It's a very, very simple formula. And then you have something called theta, which is the amount the contract loses every single day due to time decay. This number and this number is not static. They're dynamic, which means they change. There are other Greeks, but these are the two that you need to concentrate on the most. If you don't have a chance of profit, just do the opposite of delta. So if delta is 0.16, 0.17, then the chance of profit is roughly 83%. It's not exact, but it gives you a very good rough estimate. For example, this is a 0.22 delta, and you have a 76.5% chance of profit. If you didn't have the chance of profit, you would just say, hey, I have a 78% chance of profit. Over here, you would say, hey, I have about an 83% chance of profit, and it's relatively accurate. So let's do the math now. If you're a part of my website, then you have this calculator as the website. If not, then you would just have to do it manually. I would press SOFI. I would fetch the price of SOFI. And then I would say my strike price, which was $22. And the premium I'm collecting would be 0.56. And then I would do my expiration, which would be December 12th. Now, normally this would be 4 weeks, but in this specific case, it's not exactly 4 weeks because remember, I am actually doing 1 day less, 2 days less. So let me put in 3.8 weeks and then let's calculate. This specific play will be giving me 2.54% on my money. And if you do this annually, this would give you 33% on your money. Not bad to make 2.5%. So this seems like a viable play, but let me do some math. $22 strike. I'm saying that I'm willing to buy the shares on or before December 22nd if the price is $22. This is 80% in my favor, 0.20 delta or less, and I'm getting my 2.5%. Now let's do a little technical analysis because this seems like a very good play for me. The main page that you're going to be looking at is this page right here. you have a bunch of different lines. You have a yellow line, a green line, a white line, and a red line. This is technically what you like to see in a bull pattern, where the 20-day, which is yellow, the 50-day, which is green, the 100-day, which is white, and the 200-day, which is red, stacks up. You want lower to higher, not the other way around, and nothing crossing over where a lower end crosses a higher number, because that is going to be bearish. You could see that it's starting to curve a little bit down, but we're okay. We still have a ton of space. So with that said, I'm looking for support. The best support you can have is a 200-day moving average. This is the strongest of the moving averages. So by selling it at $22, this is a strong play to me, because you have the bottom of the Bollinger Bands right here at around 25.47. You have the 100-day moving average at 25, and then you're at the midpoint between the 100 and the 200-day moving average. $22 is a very strong play for me. It doesn't mean that you won't get a sign. It's just a strong play that also allows you pretty good management and some downside protection for the play itself. If you're unfamiliar with what a Bollinger Band is, it is a 95% two standard deviations of a price movement over a certain amount of time. For me, I do a 30-day movement, and that's all it is. There's other technical analysis that I would look at, but I'm not going to look at it right here. Then I would look at the stochastic, and I would look at the RSI. For the stochastic, it looks like this is getting into oversold territory, except this looks like it has a little bit more to dip. Doesn't mean it will, but it looks like it has some more to dip. For the RSI, we definitely have more space that we can go down. The RSI is only at 42 right now. You can go below 30, and that would be considered oversold. So there's definitely some more pain that's possible. However, based on the other TA and based on all the other numbers, this seems like a very solid play for me if I wanted to get into it. You could definitely do a $23 strike. You could go lower to 21. I would probably be doing a $22 strike if I wanted to get into this play right now. If you want to do it, you just click on this little plus sign. You would press continue. And when you're pressing continue, you would press review order. And it would say you're agreeing to buy 100 shares of SOFI at $22 on or before December 12th. If you aren't asked to buy SOFI by then, you'll keep your collateral and the full $58 credit. This doesn't include regulatory fees. The credit right here is my $58. Why? It's 58 cents per share. Every contract is 100 shares. Every option is 100 shares. So this would be 58 minus a 4-cent regulatory fee. It's very important to see. Robinhood charges 4 cents. Every brokerage is different. I believe Schwab, Fidelity, Chase, they all charge 65 cents. So Robinhood for me is the best one. One thing I want to show you as well, there's going to be bid and an ask. The bid is the lower number. The ask is the higher number. Bidding is what people are willing to pay, and ask is what people want. And they give you the midpoint. So you could even ask or pay a little bit more or less. So maybe you would say, I don't want 58 cents. I want 59 cents. You can play around with it as you want. And then you will press submit, and that would be the trade. I wouldn't be doing that right now because I don't want to get into this play. I just wanted to show you guys an example and just explain to you the logic. It doesn't make sense. People are panicking. People are going crazy. And it makes seriously no sense because all these companies are absolutely destroying earnings. Take a look at the screen one more time. I don't think you guys understand this. This is the SPY. Year to date, the SPY is still up 12%. The SPY is up 12%. It might be down 1.5% for the month, 3% for the week. However, it is still up 12% for the year. On average, the SPY moves with dividends reinvesting 10% a year, going back 50 years, plus or minus. This is a very positive year. If you're going to go back actually for the last 5 years, though, it's literally up and to the right with these little dips. But look at this. It dipped here, it came back, it dipped here, it came back, it dipped massively right here on Liberation Day, and it came back. This is the Fear and Greed Index. Right now, we are at 11. During Liberation Day, I believe that we had a 7 or something like this. So we are in extreme fear, which means that this is probably the best time while everyone's panicking to get into cash secured puts or buying shares, so on and so forth. A week ago, we were at 34. A month ago, we were at 28. All right. 34 is right here in almost neutral, and 28 is towards the upper side of fear. People are irrational. And this is the irrationality. It makes no sense. The market is up. Everything's doing good. It's healthy to have small pullbacks. As soon as the Fed is going to announce rate cuts, things should go up. I'm not saying the markets are going to recover. I'm not saying we're in a bull or bear market. I'm saying that people are being irrational and losing their mind. You got to stay calm as a cucumber because this is the goal. This is literally the fuel to longevity in investing. You can't go crazy. Don't over leverage. Use intelligent margin. Don't use margin to buy treasuries. Don't use margin to buy 2x funds. Don't use margin for these crazy volatile plays. Don't use margin to buy options. Right now is the time to buy shares, chill, take accumulation of the companies that you like, and just relax. Have shares, maybe sell covered calls, get some income. Don't have shares, maybe you want some income, sell a cash secured put. That's what I personally do. Nothing I'm saying is advice. You guys do whatever you want. I'm just trying to tell you something from somebody that's lived through some downturns already and really got hurt. I've learned my lesson with a lot of things. And these are just some of these nuggets that I'm giving you guys. Thank you very, very much. God bless you. Have a great day. Don't panic. Everything's okay. You're an investor. You're not a trader. Have a blessed day.